Welcome back to Click Capital, your go-to channel for market analysis and all the latest data and charts, where I share my insights from 20 years of trading. Okay, so we've bounced today across the board, had a bit of relief. You're watching yesterday, you knew I came in neutral with a few spreads and was long gold and Charles Schwab as part of a spread trade. I've had a good day, I hope you have too. Stay towards the end, I'm going to share with you how I'm positioned going forward, which I think you'll find a little interesting. So you can see here we've gapped up today and then we dipped off, took out the low, but then had a pretty good late afternoon rally into the last hour and finished up strong. NASDAQ was up over 2%, but we'll get back into that. Let's first look at the data like we always do. So bit of a sea of green out there, pretty much every sector. There was a little bit of weakness in healthcare, but we saw some big bounces in tech and finance. So with the lower rates, tech like that, and things stabilizing in the banking sector saw us a bit of a relief rally, but not too much. Let's get on over to the data. So CPI came in as expected, 6%, right on the money. So pretty market seemed to like that. I think there was fears it could be higher. So I guess the case could still be made for a pause from Jay Powell now. We've got PPI coming in tomorrow and retail sales, so they'll give us some more reads on inflation and where we think Jay's going to go. At this stage, I still think he has to do a 25 basis point. With things stabilizing, no more bank failures, maybe this storm passes away and he can get on with working on inflation. But let's see what happens. I don't think we're out of the woods just yet. Fear and greed ticked up from 19 to 26. As you'd expect. Options today, Tesla, Apple, Nvidia. AMC was off hard, 15%, which I'll get to a bit later. Meta had a nice bounce. They laid off 10,000 staff. Market loved that. Schwab was up 9%. Did well on that and got out of the spread trade, which I'll show in a bit later. And First Republic bounced 26%. So a few options been traded, and those dark pools actually didn't been buying the dip. They've just taken out new multi-week lows in the dark index. And just a bit of interesting data for you. SVB and signature failures evoke memories of 2008. And we can see here back in 2008, we got to about 150, a little bit over, number of bank failures, and total assets associated with bank failures was 373 billion. And then we pretty much trickled down to nothing. We went 2 years with no failures, which the last time we did that was 2005, 2006, funnily enough. And so we've had 2 failures and already almost reached the same amount of assets, 319 billion. So that was just a bit of an interesting graphic to put it into context, how we've only had 2 failures but racked up over 300 billion in assets in danger. So is this the end of it? Has the Fed backstop and their new bank term funding program, will that prevent a run and failure? It should prevent failures, but it might turn some banks into zombies. If they still face a flight of deposits, they're locked into treasuries, but the Fed kind of just backstops them, and equity holders get wiped out. So if you're a depositor, you're fine, but what about if you're an equity holder? That's the risk going forward in the regionals. And here just goes to show you how it's usually the unknown unknowns that always catch us by surprise. So this was a survey of what global fund managers thought were the biggest tail risks. So we've got January here in the light blue and February in the dark blue. So the biggest risk was inflation stays high, 40% of participants. Second one was geopolitics worsen. That increased in February as well. Then the third worry was deep global recession. Fourth was central banks stay hawkish. And fifth was systematic credit event. And that actually decreased in February. So 8% of participants were worried about a credit event. And that's what we've just seen come to the forefront of markets and create the biggest volatility in bond markets since the GFC. And here's another reminder not to always trust the media. It's, this looking at this makes you think like we're living in a simulation. You look at the, one of the biggest respected finance magazines in the world, with front page covers just saying how great all these people are that actually turned out to be frauds. And, they just named Silicon Valley Bank as one of their best banks as well. And how many people invested into these companies when they read articles like that. So just a reminder to be very skeptical of what big media is pushing out there as what's good. Fed fund futures today saying there's still a 25% chance almost of a pause, otherwise 75% chance we get a 25 basis point bump. So that wasn't changed much from yesterday. And a few interesting articles out today. Moody's cuts outlook on US banking system to negative, citing a rapidly deteriorating operating environment. So that doesn't sound good. Apparently they've looked into it, and I'd say they're right. Things have changed. If you think about it, Silicon Valley Bank was kind of like the first digital bank run. Because before, when they had the savings and loan crisis in the 80s, and previous bank runs in history, people had to go, get in their car, go line up at the bank. Now they just go into their app, and in 2 minutes it's all done. So that's how we saw Silicon Valley Bank lose something like $48 billion in withdrawals on Thursday last week. So it's kind of like a new world where if people lose confidence in their bank, the whole thing can just go under in a day or two. Everyone hops onto their app and withdrawals. So I think the Fed's going to have to change, the FDIC and how they backstop banks. And banks need to be more regulated with their risk management, which we'll get into in a bit. So Carl Icahn says our economy is breaking because of inflation and poor corporate leadership. He said the system is breaking down. We absolutely have a major problem in our economy today. One of the worst countries in the world as far as corporate governance. So that's a pretty big call. Leadership is worse than mediocre. So Carl's always a bit colourful, but he said, I think Powell really has to raise interest rates sooner than later. But it's hard to argue with the guy who's been, a long-term investor on Wall Street and has done really well, amassed a huge amount of wealth. So you can't discount him too much. Charles Schwab, CEO, says firm has seen significant inflows, and then he bought the stock Tuesday. So he bought 50,000 shares Tuesday morning for his personal account. Says his firm doesn't buy long duration assets and has a low loan to deposit ratio. That's what I saw yesterday as well, and why I got long Schwab. It was surprising seeing Schwab come off so much, actually, caught up in all the mess when they're a solid, well-run company. So that's why we saw a pretty good bounce in Schwab today. Silicon Valley Bank committed one of the most elementary errors in banking. Larry Summers. I'll agree with that. Borrowing money in the short term and investing in the long term. And, they didn't hedge. So just amazing. They got up to over $200 billion in assets, didn't hedge their interest rate risks. What were they thinking? Was Greg Becker, who sold $30 million of stock over the past 2 years, do you think he was sitting up there at night, wondering what happens if interest rates go up? You think the guy knows a thing or two about banks and interest rates. But him and his mates sold $84 million in stock, while risking everyone else's assets. And they just walk away from this. That's the big moral hazard in our society, is when guys like this can just get paid tens of millions, blow up a 40-year-old bank, and then just walk away. Some people might think I'm too harsh for saying that he belongs in jail, but I think he should at least give back, all the money he made. And hopefully the equity and bondholders sue him to hell and get most of that money back, because he doesn't deserve to keep it after blowing up a bank with careless risk management. It's unbelievable. Russian jet downs US drone over Black Sea. So we all kind of forget that there's this ongoing war that could really spill over, could even possibly go nuclear. Putin, if you think of Putin like an angry dog who's been pushed into a corner. And you think about what's really got to him is, grievances built up over decades. He's seen the downfall of the Russian economy and the rise of the American economy into power. And, he's getting towards his later years. and he doesn't like to be made, a fool of. So this thing could still, this is not over yet. And with this, Russian now taking down US asset, this could still spill over into something a lot more serious. And we all remember how on edge markets were when this first happened. So that's still a risk there in the background that I think a lot of kind of discounting, forgotten about, because we were all kind of just used to, there's a war in Ukraine, but it could escalate further, which I'd imagine the markets wouldn't like. Okay, back over to the charts and let's look at some price action. Let's go back to the daily chart. And we'll come back to the main indices. We saw NASDAQ did really well today, almost got above its 50-bar VWAP to close, and on some pretty good volume, up 2.3%. Internationals, little bounce as well, but they're still all below their 50-bar VWAPs, so downtrend. Volatility fell today, as you'd expect. We had that huge spike yesterday, so things kind of stabilized, but I don't think we're out of the woods just yet. VIX at 23, and if you look back in past, whenever volatility spikes, it tends to go on for a few weeks or a few months and longer. It's rare that we've gone from, volatility just asleep at the wheel for months, and then we go into 3 bank failures, the 2 biggest bank failures since the GFC, bond volatility at the same levels from the GFC, and then a few days later, we're all back to normal, all good, nothing to see here. Be surprising to see VIX back at under 20. I don't think this is all over yet. They might have plugged a hole in the further bank failures, but in terms of market on edge and volatility and sentiment and liquidity and all that, I don't think it's all over yet. Bond volatility is still really elevated up here. But we did see a bit of a bounce in the breadth today. Still got only 42% of stocks above their 200-day average, so structural downtrend. We did see the growth sectors have a nice bounce today. High beta versus low volatility. Growth versus value actually broke out for the year. So this trade looks to be back on, the long growth, short value. And same with tech versus SP. That just broke out today as well. Strong price action. So lower rates, tech loves lower rates, basically. And finance energy isn't doing too well, so that's why we're seeing the Qs outperform here. Yield curve minus 5.6, bounce in high yield, still pretty low here, and we saw a little bounce in the 2-year today. Actually, a pretty big bounce, relatively speaking, but compared to the last 3 days. And we've still got September Fed Fund futures at 4.48. So they've bounced somewhat because after yesterday's crazy action, but still really low here. So this volatility looks like it's going to take a few weeks to settle down here in bond volatility. So it's going to be all over the place for a while here, I think. Treasuries came off today, 1.6%. We saw a bounce in high yield, but still looking kind of weak here. Wasn't a big solid rebound, didn't take out yesterday's high. Dollar, kind of flat, just came down a bit. It's just sitting down here, not doing too much. Bitcoin actually got up to 26,000 and a half, but sold off on a bit of a shooting star there. And commodities sold off, and look at oil. Just go out to a weekly chart on oil. This looks to be breaking down. So we've got this bit of consolidation here. There is support a little bit lower. If we take out this one as well, it's kind of like the last stand for oil before this might go into a negative confirmed downtrend if we make a lower low here. So it doesn't look too good for oil there. Over to the sectors, they still kind of look broken, below their 50 bars, except for semis holding on a little bit there. But other the sectors, we've had a bit of a bounce here. It almost kind of feels like a bit of a dead cat bounce to me. Retail's sitting down there. And here's the financial sector. That bounce today, and regionals. We gapped up huge and then just sold off into the day. So it looks like there was a lot of money waiting to get out on that higher price. Had home builders have a little bounce. And funny enough, Jets was the only negative sector, and it had a bad day yesterday, down 3.7, and that was down again today. Defensives had a little bounce, kind of a little bullish turn here and price action, but still below their 50 bars, not much going on there. BlackRock bounced, and here's the S&P. JP Morgan up 2.5, and mega cap tech had a good day. Apple up 1.4, Microsoft up 2.7, Amazon up 2.6, Google up 3.1. Meta with laying off those staff, the market loved that. Gapped up, held, finished on its highs. And semis had a strong day as well, with AMD up 6.6 and Nvidia up 4.7, but it does have this roof. We haven't taken out new highs on Nvidia, so it's kind of at a bit of an intersection here. Is this going to prove to be kind of like an island reversal, where we can fall back down below the 50 bar, or is this going to break out to new highs? So we'll be watching this. The AI hype train may go further. We are short, but we do have a stop in case the AI hype train goes into overdrive. We don't want to be caught in this ripping too hard. But for now, the risk reward on a short setup is good. It's significantly overvalued. It's really technically overbought compared to the rest of the market. And if things turn sour, this thing should dive back down into the 100s in no time. Tesla had a nice bounce today, up 5%. So we may have found support here around that 165 level. But let's see if we can get above its 50 bar. And it's still got all this mess above it here to get through. So for now, I think it might just kind of chop around with the market. I don't see any clear direction there in Tesla. Meme stocks. AMC off 15% today. Ouch. I didn't even look to see what's going on in there. Big Bear off 17%. AI off 3%. Looks to be retreating a bit. Peloton off 6.7%. And here's the banks today. So Bank of America was kind of flat after gapping up. Citigroup was up almost 6%. Wells up 4.5%. And the regionals. There's nasty price action. This crazy stuff going on in the US banks. This looks like the price action of penny stocks or some crypto coins, but no, it's some of America's biggest banks, and so it's just crazy. It's just too crazy to trade all these, Western Alliance and First Republic. You can see here in after hours we're up almost 10%. So these things have pretty much just turned into casinos here. From an investment point and trading point, I mean, who knows? Like I said, they could just turn into zombies. They might not fail and get liquidated because the Fed's backing them, but what was if all their customers take flight, to the point where they're just, they're kind of just stuck in this, kind of on life support kind of thing. So I think that could be a scenario for some of these banks. I think there might be still a couple more to go, but may not actually fail. But yeah, big bounce in those ones today, as you would expect. And Schwab, I was long this one yesterday, spread it against the Vanguard Financial ETF. I got out as that one as well because that was as much of a bounce as I could hope to see this morning. And yeah, like I said, who knows? This thing could go 10% either way tomorrow. So it's pretty volatile out there. Oh, and I also forgot to comment on gold. I was long gold yesterday as well and got out of that today as well, as it couldn't take out the high. So I saw it gap down. It's just kind of trading really soft. And I thought, well, that says I'm happy with those gains over the last couple of days. And I still like gold here, but I'm just swing trading for a couple of days to get my gain. So I'll keep an eye on gold. I still think we could break out here in the next week or so, break out to new highs. Okay, so back over to the market. Pretty good bounce here today. Just go to equal weight, S&P. Pretty good bounce here today. Kind of a lot of indecision, except for tech. Tech finished on a pretty good green candle. Couldn't take out its 50 bar though. And a lot of volume here. And small caps as well. But I don't think we're out of the woods just yet. I think this thing kind of feels like a little bit of a dead cat bounce. I still think, with all this volatility in the bond market, and this, and in the banks as well. I just don't think the market can just shake this off and forget about it and go back to everything's all normal tomorrow. And we're not sure with now what Jay Powell's going to do. I think he's kind of stuck either way. If he pauses, then he's got egg on his face, and then inflation's going to, he's kind of abandoning that, and that's a big problem. If he does raise, that could be putting more pressure on banks and their balance sheet investments and long-dated treasuries and stuff like that, and the pressure's still on them. So there's that, and then geopolitical tensions rising. Russia just shot down an American drone, so that can't be a good thing. That can only escalate further in one direction. And so I used this opportunity today in this little bit of a pullback and dead cat bounce to add some shorts. I think we could still go a little bit further up tomorrow. I wouldn't be surprised if we pull back. We're almost at a 50% retracement from this move down from the 6th of March. On the Qs, where it's actually more like a 61-70%. And the markets are still all under their 50-bar VWAP. So I don't know if we've seen the end of this yet. And I managed to find some good short setups today. Not in the strong mega cap tech stuff, but some other stuff that's looking weak. So I've still got a few spreads on in the financial space and ETFs that kind of acts as a bit of a long exposure. So to offset that kind of long exposure, if things settle down, I added a bunch of shorts. And so I'm 100% net short stocks, but I still have some spreads that act as kind of long. So even though I'm net dollar 100% short, if you were beta adjusted or something, I'd probably be more closer to 50% with the spreads. Because if things calm down and they do go back to normal quickly, then my spreads should close in pretty quick. If they don't, then my shorts should fall apart. So I don't think we're out of the woods yet with all this thing. Bond market volatility, everything that's going on, the VIX at 23. I think we could easily see lower prices over the next few days. And who knows, maybe we get our first 3% or more down day for the year on the SPY and Qs. So coming into mid-March now, and we still haven't had a down day more than 2.5%. It's got to be in there somewhere. So dollar-wise, I'm 100% net short. And that's all I got for you today. Thanks very much for tuning in, and I hope to see you again tomorrow afternoon. Cheers.